I'm Greg Hunter. Welcome to USAWatchdog.com. With us, a guest hasn't been on a long time. He wrote this book, 10,000 Gold. Yes, he still says gold should be $10,000 an ounce, and it really should be way higher than what it is right now. And he'll talk about that. He is Nick Barisheff. He is the CEO of the Bullion Management Group up in Canada. Nick Barisheff, thank you for joining us today on USAWatchdog.com.
Oh, my pleasure. Thank you for having me.
Nick, you wrote this book years ago, and the case for $10,000 gold, which is still a good case for $10,000 gold. And it seems like gold has caught a bid. Some big players, namely Ray Dalio, Mark Mobius, the CIO of BlackRock, all touting gold. Where are we with the gold arc and its probability to go well to $10,000 gold?
Well, the issue is at this point, the central banks are the main buyers of the physical bullion. Are buying more physical than any other time in history. The investors, the hedge funds, the Ray Dalios, unfortunately, many of them are buying the GLD. And the GLD contributes nothing to the supply-demand fundamentals because the authorized participants borrow the gold from the central banks and contribute it to the ETF. So it's just paper. And the big problem with that is that if the authorized participant becomes a Lehman Brothers, the central bank has the claim on the bullion because title to the bullion always remains with the lessor, which is the central bank. So the ETF investors are going to get a big surprise at exactly the time when they need the gold the most.
So these big players are not actually getting and vaulting gold like with something like Egon von Greyer's would vault up in Switzerland. I think he has another vault in Asia. You're not talking about people vaulting tonnage. You're talking about paper gold.
They're shifting paper around, and they've got custodians on top of sub-custodians on top of sub-custodian. I know Catherine Austin Fitz has been on your show, but she's done an extensive report on the flaws in the GLD. And I have to hand it to the lawyers and bankers that did the documents, because it's all very cleverly disguised, cleverly worded. When you look at the material, it says the authorized participants assemble the basket for the ETF. Well, why did they use the word assemble instead of buy? Okay, well, because they actually borrow it. And it's the same whether it's an equity ETF or a gold ETF. And people are deluded by the fact that the management fees are low. So this is going to be a big problem because it's like one giant fraud.
Do you think that we're getting close to gold going much higher? I think in the pre-interview you said gold really right now should be $2,200 an ounce.
That's right. If you look at the chart of U.S. debt against the gold price, they were perfectly correlated till about 2011. And then in 2011, the U.S. debt kept rising, but the gold price declined, so they diverged. And I think the divergence was largely due to the manipulation, which comes in many forms. But to get back to the correlated status of the gold price to U.S. debt should be 2,200 right now.
2,200, and why why is it being held down? Is it just simple trading that's keeping it down? Is it supply and demand? I mean, for years everybody's heard that, and there's been a lot of proof with all the crime and convictions now of manipulation in forex and gold and silver. I mean, a Deutsche Bank got caught doing this. Other big banks have got caught doing it. J.P. Morgan Chase, they got a case right now with their trading desk that they're claiming was a quote criminal operation, a criminal enterprise. What's going on with the price? Is it going to be held down forever?
Well, no, it's like, holding a balloon underwater. The deeper you go, the faster it pops up. The the issue, this manipulation has been going on a long time. There was a lawsuit in 2003 by Blanchard and Company against Barrick and J.P. Morgan at that time. And J.P. Morgan admitted to the manipulation, but they said that they were doing it on behalf of the central banks, and the central banks are immune from lawsuits. So as agents, they're immune from lawsuits, and they got off then. So that was one of the things, but the admission was there. When you look at it, of course they're manipulating it because they need to have the perception of the strength of the U.S. dollar. And gold's the anti-currency and the anti the U.S. dollar, particularly because it's the reserve currency.
Are they going to make some headway with this J.P. Morgan thing? Some people are saying, "Hey, woo, what's up? Heads up." And some people are saying, "Listen, I'll believe it when they actually, go after them. Just instead of just the three guys that they went after, that they go after."
Well, I think it's the latest thing I've read. It's now 16 people are potentially up for charges, and they haven't got I've been in the business for 40 years, and there's no chance that the compliance officer and senior management didn't know this was going on. No chance whatsoever.
And do you think this is going to be the RICO action that everybody is touting, that they're going to actually have a RICO case, an organized crime case, that the people's trading precious metals? Go ahead.
The important thing is, see, after the criminal case gets done, then you're going to have class action civil suits by all the gold investors that lost money because of their manipulation. So that'll be a giant lawsuit, and maybe several giant lawsuits. So that's coming next.
Is that going to put a chilling effect on the manipulation?
Well, you would think so once they get fined on the U.S. dollar manipulation. The 6 banks were fined $5.4 billion. So the fines are getting to be significant. Up till now, the fines have been less than their profits, but once you get the fines higher than their profits, and some people go to jail, then the people that are left are going to think twice about doing it. The material that I've read, they're talking about potentially 30 years for this.
Wow. Is this something that is all of a sudden now it seems like the strongest case to me seems like it happens in the Trump administration? Is Donald Trump purposely trying to end the manipulation? What are your thoughts?
Well, possibly. He seems to have always been positive on gold and a supporter and so on, and now he's had a lot of negative comments on the Fed and the detrimental effects on the Fed. So that's quite possible.
And what do you think his role with the negative comments on the Fed is? What do you think his goal, I should say, is with all these negative comments? I mean, he's been saying that the Fed is our enemy, or they're stupid, they're boneheads. Quote boneheads, that they've raised rates.
I think putting words in his mouth. The issue is that if you were Trump and you saw that there was going to be a market correction imminently, then you want to blame it on somebody. So if the market correction comes, he's going to say, well, it's the Fed's fault because they didn't drop rates fast enough.
And do you think a market correction is coming?
I think it's a very good chance. We've done an audio CD with about 12 of the top economists, and everything from Greenspan on down, and they're all concluding that this next correction will be worse than 2008 and possibly worse than 29. This is the first time, I've been in the business 40 years, that we have a simultaneous triple bubble, a bubble in real estate, stocks, and bonds at the same time. Usually it's one or another. In 1999, it was a stock bubble. In 2007, it was a real estate bubble. This time we got a triple simultaneous bubble. So when we have the correction, it's going to be massive. The various evaluation methods on the equities put us at a position that's worse than 1999, in some cases like 1929. But the big problem is this triple bubble is sitting on a mountain of debt like never before.
What do you think happens to all this debt? I mean,
Well,
what do you think the end result?
Because if you look at the USA debt clock, they do a number that's the 22 trillion cash debt, and then there's 120 trillion of unfunded liabilities. And if you look at what that means per taxpayer, it's over $1 million per taxpayer. It's about 380,000 per individual, every man, woman, and child. But more importantly, it's $1 million per taxpayer. You think that's going to get paid? No chance.
So what does this look like if this blows, and you've got all these economists in this new CD that you have at Bullion Management Group? What does it look like when it blows up? Describe it.
Well, it's like I say, it's going to be hard to imagine, but it'll be worse than 29, because when you have a triple blow up, particularly in real estate, then you really have a negative effect on the economy as a whole. And we've got so many things that are rising to the surface at the same time. For instance, if you look at the connecting the dots in the pension crisis, there's a huge amount of unfunded liabilities. First of all, with the U.S. pension plan, it's destined to be completely out of money by 2035. Then you have all the state and all the municipal, all the union plans. They're grossly underfunded. So that the simple math of it is that if your pension fund has, say, $1 million in pension assets and 100,000 in pension liabilities, and the market tanks 50%, your pension assets become 500,000, your liabilities become 600,000, and the corporations have to liquidate the excess liabilities within 10 years. So it's a huge drain on corporate cash flow. It'll have a huge effect on corporate share price and CEO bonuses. And most CEOs are too busy on their treadmill and not paying attention to this giant problem that's coming down the pipe.
And what about for John Q. Public? What does it look like to the guy on the street when this triple bubble blows up? Do they just all lose their jobs? Do we have high inflation? What do we get?
Well, I think you're going to have riots in the streets, because it's already happening in California. CalPERS is the pension fund administrator for a lot of the municipalities in California. So already retired teachers, firemen, policemen that are sitting there in retirement getting their pension checks got letters saying, sorry, but from now on, your pension checks are going to be reduced by 60%. Well, how do you get by then? You're probably barely making it on 100%. But this is already happening. The truckers' unions have had a big reduction. That's not theory anymore. That's already happening. And again, after the dust settles a little bit, you're going to have massive class action suits against the CEOs, the executives, the pension trustees, the consultants. Somebody's going to be held to blame by the lawyers doing the class action lawsuits. And the blame is very simple. I mean, I've done a lot of studying on the pension funds, and I've kind of, after 20 years, come to accept the fact that people have an irrational bias against gold. There's only 3 pension funds that have gold: the Texas Teachers Pension Fund, the Dutch Pension Fund, and in Canada, Unifor, which bought gold from us earlier in the year. That's it. Now, if the pension funds get wise, they'll move into both gold, and they also don't have any REITs. But the thing is, if they don't, and they get into the lawsuit, they'll have no excuse for this, because everybody agrees with diversification, but nobody does it. So you got pension funds, all they have is a 60-40 allocation to stocks and bonds. What about real estate? What about commodities? What about gold? The big funds will have that, but the ordinary run-of-the-mill fund that hires portfolio managers and consultants has nothing. And these are the two best asset classes, gold and real estate, and yet they choose not to have them at all.
What does it look like for people without a pension? What does it look like? Do their food stamps stop? Do we have big inflation? Do people, is there massive unemployment? What does it look like to people without any pension, without getting a cutback?
I think that the only thing, the option the only government has is to print more money and postpone the problem yet a little bit longer. But that leads to massive inflation and eventually hyperinflation. Every fiat currency that was ever existed has always ended in hyperinflation. Every single one. Since 1800, there's been 56 hyperinflations. And hyperinflation is defined at 50% inflation rate per month.
And you think that's where we're going eventually for the Federal Reserve note?
Yeah, I think what other choice is there? So eventually, you may have an initial round of deflation as the debt defaults, but then as the Fed steps in and tries to bail things out, they'll print the money, and it'll go into hyperinflation, and then followed by a complete collapse, just like it has 56 other times in history.
The Federal Reserve was out this week. They cut rates, and then Powell more than hinted that they're going to organically grow their balance sheet. They're going to start buying bonds. They're going to start printing money. Basically, it's going to be more QE. They're going to be printing money. Is this the beginning of that? Do you think that they're, in simple terms, for John Q. Public out here, was that what that means? That they've just cut rates and they're going to start their what they call it, repos or open market operations? They're going to print money. I mean, isn't that the beginning? Isn't that what they've started up again?
The precedent's already there, because Switzerland used to have the strongest currency, and now the Central Bank of Switzerland is the biggest equity investor in Swiss equities. What's the central bank doing buying equities?
Rick Ackerman came out, many months ago and said, in the meantime, before we get to a crashing dollar, we're going to get a dollar short, a short squeeze. This is Rick Ackerman. Right. And sure enough, that's what's happened. Can you explain that to our viewers of why the dollar looks so strong and why it's destined to crash eventually?
Well, the issue, it's like the cleanest shirt in the laundry syndrome, is when you look at the global currencies, and we've done a chart. I've sent you a copy of this chart that shows the performance of gold and all the currencies. So in the US dollar since 2000, gold is up an average of 9.4% a year. Some countries it's 14% and so on. But overall average, when you take all of the countries, the average increase is 10% already. And
a year.
Yeah, a year, average a year. And pension funds and their consultants and so on, they don't think it's necessary to buy gold. When last year they managed to lose 5%. They could have just bought gold and sat on it, and it was that simple. And they'd have less of a pension deficit, so on. We've done another chart because, for instance, every time Warren Buffett's on CNBC, he seems to go out of his way to disparage gold. But if you look at the chart of Berkshire Hathaway and gold, well, gold has outperformed Berkshire Hathaway.
And Berkshire Hathaway, because of the incompetence of Warren Buffett, and he is an incompetent little boob, required a government bailout back in '08 and '09. You know, Charlie Munger says, just shut up, we had to be bailed out. I mean, that incompetent idiot, don't get me started on Warren Buffett loaning money to GE, you know, the bigger fraud than Enron, according to a recent publication by Marco Polos. The guy that busted the Enron scam. You loan money to Goldman Sachs, who would have gone under if we wouldn't have bailed out AIG. I mean, the list goes on. He was a big buyer in Wells Fargo. Anyway, sorry. Back to Warren Buffett. Yes. So gold's outperformed his stupid fund. You know, the master of Wall Street, and just some piece of hunk of yellow metal has outperformed his tail. Go ahead.
Well, that's the thing. Everybody worships Warren Buffett as the best investor in the world, and gold has outperformed it in U.S. dollars. You know, so I wouldn't disparage gold if I was him. I'd, you know, keep quiet about it.
How bad are we going to make it past 2020 before this thing unwinds, or do you think we get an unwinding, a reset, whatever you call it? Do you think we get a reset before the 2020 election?
Well, there could be, but I think that, you know, everything conceivable will be pulled by the Trump administration to avoid the reset and the crash till after the election, because that obviously will complicate things. So there's a good argument that it will happen before, but there's also a good argument that they'll manipulate it a little bit longer and have it postponed till after the election.
Does that mean that the Fed will cut interest rates to zero or near zero eventually?
Well, it could be. It's hard to say whether the Fed is, you know, on the right side, or it's dealing with its own agenda. I mean, if you look at 1929, the central bank created excess liquidity, and then following 1929, they pulled a third of it out, and that was the cause of the crash and the depression. So, what was the agenda then?
Kind of like raising rates 7 times in 2.5 years of Trump administration and burning $50 billion a month. That's kind of pulling money out of the system, isn't it? And now we've got the ship listing. I brought this up in my weekly news wrap, and they put this boat anchor, and now the ship is like, you know, lapping water up over the deck, and they're like, well, maybe we'll cut a quarter. So I don't know. I mean, I think the Fed's going to take the blame on this, is it not? I mean, didn't the Fed cause this?
Certainly, if there's a crash before the election, then Trump is going to blame the Fed that this was all avoidable if they'd done what he told them to.
He's going to have a good case, is he not?
Well, it'll be a good theoretical argument. We don't know that, you know, if the Fed cut the rates, that it would avoid everything anyways, because there's so many other problems that aren't just directly related to interest rates.
If I was your brother and I was saying, hey, listen, Nick, I'm worried about the economy, you know, and we're just sitting here, you know, having a coffee and a donut at Dunkin' Donuts, you know, or what it was, Tim, what's his name? What's it up there in Canada? Tim.
That's right.
What's his name? Tim. It's a hockey player.
Right.
Yeah. Anyway, Tim Horton. If we were at Tim Hortons and we were up there having a coffee and a donut, I'd say, you know, Nick, I'm worried about this. What would you tell me to do? If I was saying I'm worried, give me some advice, Nick. What would I tell you to do?
Get a copy of my audio CD and play it in your car, because the beauty of the audio CD is you can play it again and again, whereas you'd never read a book like 5 times. And the audio CD will give you the confidence to buy gold and sleep at nights when mainstream is going to be, you know, talking it down and disparaging it. So you have to educate yourself first, because you'll be in no position to buy gold unless you really understand things. And I think the CD, I've had a lot of compliments that it's very easy to listen to and very educational.
And this is a CD version of this book right here.
Book, right?
Yeah, the CD. And so you and then you have all these interviews on this CD as well with these people, right? With the experts that you're talking about. Or is that a different CD?
Another CD we have that's called Market Crash. So those are all YouTube interviews and so on. But these are Greenspan, Dalio, Stockman, Jim Rogers, that kind of thing.
And so somebody at BMG interviewed these folks, and you'll send me some links so that people can also see these guys talk about gold.
We didn't interview. These were interviews that are all publicly available on YouTube.
That you just lifted them out and put them in there. All right, good. And I guess we'll just wrap this up. I guess if you were going to handicap this, so you would tell people right now that you should have some. A lot of people don't have any. I'm not saying I tell people don't bet the farm, but you should have some if you have none. Some people say, you just pump gold, but
disagree with that philosophy right now. For instance, in my case, I'm 100% in precious metals.
Wow.
And the reason is, in normal market conditions, yes, have some 10 to 20%, because then it'll reduce portfolio volatility and improve returns. That simple. Hope that Armageddon never comes. But in the position where we are now, and we're launching a hedge fund that uses this strategy, is right now you invest in gold only. Okay, you wait for the market correction, and at the bottom of the correction, you invest in your favorite funds or stocks. To give you an example of this, in Canada we have a real estate investment trust called the Dundee Dream Office REIT. It's a $12 billion REIT. At the top of 2007, it was paying a 4% dividend. But because of the market crash, it crashed 89%. And the dividend yield became 30% a year dividend yield. The reason being is because REITs and mining stocks are disproportionately affected in a market crash because they're relatively thinly traded. So even though the rental income in the office building, everybody was paying the same rent they were in 2007 and 2009. So what you have is the same income, but a much lower share price. So this is the opportunity. So staying invested, maybe the stock market will go up 5%, maybe not. But sooner or later, in the very near future, it's going to drop at least 50%. Okay? And you will not live long enough to break even. So step aside, and the place to step aside is in gold, and do your homework and decide what you're going to invest in at the bottom.
And you're saying that you're 100% in gold. I mean, you're saying that this is going to be so bad that you're not going to be in any stocks, any bonds.
Well, because I always measure the performance of the investment in terms of gold ounces. How many gold ounces do I have to put in, and how many gold ounces will I end up getting back with reasonable assumptions? And when you measure it in ounces, might as well leave the gold in the vault. There's nothing worth investing in to take out the thing. It's highly risky. And the gold's doing 10% a year. How many people's portfolios are doing 10%?
And would you buy silver?
Yeah, absolutely. But silver will initially decline when the market declines, but after that, then it'll surpass gold because the ratio of gold to silver has improved, but it's still way off. So silver's got a lot of catching up to do, so is platinum. So eventually they'll outperform gold, but gold will be the first one to move.
Do you think that there's going to be a big sell-off in gold and silver in the near term, or have we already had that?
I don't think there's going to be any kind of sell-off. The only sell-off will be in the paper gold comics and everything, but it's not going to happen in physical.
So you think that we've seen the bottom in gold and silver?
I think so, yes.
Wow. Wow, wow, wow.
The bottom was in the fall of 2018.
The bottom, and then so you see dark clouds on the horizon, but sunny days for gold and silver.
That's right.
All right, Nick Barisheff, thank you for joining us today on USAWatchdog.com. Your book, which you put out years ago, is now have an audio file as well that you can get, and you can listen to it driving down the road. It's a $10,000 gold. It was out in 2013, but totally relevant. All the math lines up today. And as a matter of fact, we've seen this big with this catching a bid in gold and silver. Nick Barisheff, you're the CEO of Bullion Management Group. I appreciate you coming on and sharing your thoughts with us. Thanks for joining us today on USAWatchdog.com.
Well, thanks for having me. My pleasure.